Welcome to Earnings and Option Trades, Things to Consider. My name is Sean Howell, and I'll be your host. Thanks for joining. Let's get started. Earnings news often bring greater volatility to the markets. With higher volatility, there is both increased opportunity and risk. Let's take a look at some option concepts to consider if your plan is to trade options around earnings. And with this video and this content, really I'm anticipating that you've gotten a few option trades under your belt. If you need a little bit of a brush up, my suggestion is to go to etrade.com/events and take a look at some of the other videos that we have associated with options. After you watch those, I'm sure the rest of this information will be more relevant. There's two types of volatility. Often you'll hear me refer to it as vol. The two types of volatility that drive an options price are historical and implied volatility. I'm just going to cover a few bullet points here, and then we'll diving into a little bit more details as I go through the other slide. Well, historical or statistical volatility is really backward looking. It's simply what has the stock done as far as its variations to the upside or downside. I'm sure you've observed stocks that generally only move maybe 0.5% up or 0.5% down on any average day, and a big move for those stocks may be up 1% or up 1.5%, whereas there's other stocks that you've probably seen that an average day to them is up 3, 4, 5%, down 3, 4, 5%, and a big day for those stocks, something like 8, 9, or 10%. So again, that kind of allows us, when we look at historical volatility, to compare what things have done in the past. Historical volatility is a key component of the Black-Scholes options pricing model. This will kind of allow us to understand why an option has been trading at the values that it has. Again, backwards looking though. And another thing that's important to understand is that when we're looking at historical volatility, it tends to revert to the mean. So in other words, if a stock has a mean volatility of 30 and it's been trading recently with a volatility of 40, we don't anticipate that it's going to stay at that higher volatility level. We expect that it's going to contract back down to around a 30 level. Kind of like if you live in a climate that is average 75 degrees and temperature spikes to 105. It's a pretty safe bet to say, I think tomorrow is going to be cooler than 105 because you know that the average is 75. Now, the same thing is true, the tendency to revert to the mean, if that stock that has an average vol of 30 has been trading with a volatility of 20. We don't expect that it's going to stay down at 20 forever. We expect that it will revert to the mean and it will make its way back up. So in other words, an expansion of volatility. Now, when it comes to implied volatility, this is really going to be more forward-looking. It's driven by market forces. So if we're anticipating that earnings are coming up, and we know that this stock generally trades with a volatility of 30, and then we look at the options and we say, wow, look, these things are trading with a volatility of 40. That shouldn't be surprising because as an event is getting closer and closer in the calendar, like an earnings event, generally what we see is people start to place their bets. They're buying calls, they're buying puts. They're starting to anticipate bigger moves based on something on the calendar. An event on the calendar is often called a binary event, and an earnings would be considered a binary event. So implied volatility helps us to kind of understand a little bit what people are willing to pay in anticipation of the earnings, but also it allows us to understand what the market is predicting. Now, when I say the market is predicting, I mean the people that are buying calls and buying puts. What do they think the market is able to do? And I'll dive deeper into this concept in future slides. The third bullet point is one to definitely consider, though, and that is that implied volatility historically overstates. In other words, people tend to anticipate that the market is going to make a bigger move than it does. And we've got some great tools that are embedded in Power E-Trade that I'll show you how we utilize those so you can kind of understand what's the historical volatility been, what's the current implied volatility been, what's the predictive nature of this right here, and we can take a look to understand if it's historically overstated and how much it historically overstates. So you'll get a better concept of that as we go through the slides, but historical and implied volatility, key concepts in understanding earnings and option trades. Let's take a quick look at McDonald's Corporation. We'll take a look at the price chart, and you can see that I've got implied volatility and a historical volatility study across the bottom. Let's do a quick analysis of it. Now remember, implied volatility usually overstates versus actual. Let me show you what this looks like on a chart. And the reason I've picked McDonald's is really it's a stock that I don't have to do much explanation as to what they do. So very simple one to look at. But you can see that across the bottom, I've added volatility. Implied volatility is going to be the red line, and historical volatility is the green line. If you look at the chart that I'm showing, and what I've got here is a 1-year chart, you'll see that implied volatility is usually overstating historical volatility. But you can also see in the green box that there are periods of time in which historical volatility exceeds implied volatility. And if you look straight up from that green box, you're also going to find an E. That E indicates that that's earnings. So in this case, the historical volatility, or the price behavior, exceeded the implied volatility, meaning the move was bigger than the options market had anticipated. And again, we go for a long period of time in which the implied volatility exceeds historical volatility, went through another earnings season, and in this case, it held true to implied volatility overstating. But then soon thereafter, we did see a short period of time in which historical exceeded implied. And then again, we went forward with the implied volatility exceeding the historical volatility. As we just observed in that McDonald's chart, the one time that we clearly saw that the implied volatility did not exceed the historical volatility was around an earnings season. So we have a tool in Power E-Trade which is called the Earnings Move Analyzer, and it's a really great tool for the options trader. It lets us kind of go back in time and take a look a year ago or all the way out to 3 years to take a look at what has the options market done around earnings season. So let's go ahead and do a quick analysis of it. So I've got McDonald's in here in the Earnings Move Analyzer, and across the top you can see that we're going to look at options implied move, a negative earnings move, positive earnings move, average implied move, and an average actual move. If we go back to the earnings that was April 29th of 2021, you can see that with the purple line, we were anticipating that the implied volatility was anticipating a pretty decent move here, over 2%, 2.22% to be exact. And then you can see with the green line that the stock did move to the upside after earnings, but it did not move as much as the implied move would have anticipated. And then you'll notice for the next earnings cycle, that would be the July 28th, 21, that for the most part, the expected move held the same as it did before. But notice in this case that it was a move to the downside, but again, the implied volatility exceeded the historical volatility. Let's move forward to the October 27th, 21, where again, the earnings estimate, the implied volatility, held right at about that 2.22%. But in this case, notice that earnings were to the upside, and the upside move exceeded the implied move in that case. So what happens is the option sellers that I guess you could say kind of unanticipated that the move was going to be that large, they weren't willing, kind of the fool me once theory, they weren't willing for the January 27th, 22 earnings. They were not willing in that case to sell the options at a lower premium like they were in the previous quarters. So in this case, notice that the implied move went up higher because those sellers said, I'm not going to get fooled again, and I want more money if you want me to sell you a call or sell you a put. Now, oddly enough, in this case, notice how the earnings were to the earnings move, post-earnings, the stocks move was to the downside in that case. So in this case, the implied move dramatically overstated the actual move. Well, look at the next move. Now, granted, when I took this slide, this was when I created this slide, this was March 1. And earnings don't even come out until April 28th. So this is taken well in advance. But notice how much higher the option premiums are for the next earnings that are coming out that haven't even happened yet. Now, that's a component of a number of things. One of them is just the overall implied volatility of the market is higher right now. We've got the Ukrainian crisis going on. So we're seeing much higher move in the volatility index, the VIX. So that's sort of manifesting in just overall higher option valuations across the board. Now, to the right side of this, you can see that the current implied move is that the stock will be up or down 3.76%. That is what the options buyers and the call buyers and the put buyers are anticipating that type of move. The implied dollar range based on what they're currently willing to pay is that the stock will be a little bit below 231 or a little bit below 249 based on what people are willing to pay. Now, the implied volatility rank is at 126%, meaning that over the past year, the options have not been priced this high. So if you're an option seller, you're probably thinking right now, okay, I can collect a pretty handsome premium. Granted, there's a lot of volatility in the market, and we're still pretty far away from earnings right now, but the implied volatility rank is 126%. Again, the option prices are at a more than a year high at this point in time when I took the screenshot. The current implied volatility is 26%. So kind of giving me an idea. I know we're at the high end, but the current implied volatility, remember, when it's to the high end, we expect that it's going to at least revert to the mean. In this case, it's 26.08. Now, the average implied move is 2.22. The current implied move is 3.76. So historically speaking, the option buyers, as we're leading into earnings, are willing to pay 2.22%, pay for a move of 2.22. Right now, they're willing to pay for 3.76. So the predictive nature is they're expecting a much bigger move. Now, the next one is pretty important. That is the average absolute historical underlying move over the past year has been just a move of 1.53%. Notice it's not talking about an up move or a down move. It's just talking about the average implied move because volatility is not directional. It's really talking just about a range. So as we start getting into strategy, I'll be talking more about, instead of trying to pick a direction, let's go ahead and pick a range. And that will be the strategy that we focus on as we get into the next slides. A quick concept for us to cover is how volatility expansion and contraction affects pricing, and it's important that you understand Vega. Vega is the expected change in an option's value with respect to a 1% change in volatility. So as I've been talking about an option that trades with a volatility of 40 with a mean of 30, it's important to understand what would happen to the price of calls and puts if volatility were to contract and revert to the mean and go from 40 to 30, or expand from a current vol of, let's say, 20 and go to 30. How does that affect everything? And the way that we can do this is to just quickly cover Vega. Vega is the highest with the at-the-money options, so keep that in mind. At-the-money options are going to be most sensitive to changes in volatility. Vega usually declines as an expiration nears, so as we get closer and closer to expiration, the options become less sensitivity to volatility changes. If we're looking at the Black-Scholes model, and I'm going to do a couple of inputs here to explain this, if we throw in a $100 stock and a $100 strike price, so that's going to be an at-the-money option. We're trying to exclude any intrinsic value, and a 100 days to expiration, so again, sticking with that 100 theme, and a 1% interest rate, trying to normalize everything that we can. The Black-Scholes model will spit out a Vega of about 21 cents. That means that if we're looking at an option that is trading with a volatility of 20, that would give us a call valued at about $4.37 and a put valued at $4.09. If volatility were to go up 1 percentage point, in other words, if it were to go from 20 to a vol at 21, that expansion in volatility, look at what it did to the call price. It went from $4.37 to $4.58. And also the put price also increased from 409 to 430. So an expansion of volatility is going to make an option more valuable. A contraction of volatility is going to make an option less valuable. So if we go from a 20 down to a vol of 19, the call is valued at 416 and the put is valued at $3.88. So understanding more about how the option price change with an expansion of volatility and a contraction is important, and it also puts a little bit of the earnings move analyzer, into a better context where you can say, oh, if we go from a vol of 40 and it contracts to, let's say, a vol of 30, am I long Vega or am I short Vega? Is that contraction going to benefit my trade or is it going to harm my trade? So Vega is an important concept as we start to get into the strategy. I talked a little bit about how do we look at volatility within a range. And in Power E-Trade, we have what's called an implied volatility constellation. And that helps us to recognize the volatility range. So in the upper right-hand corner, you can see it says hide IV constellation. You're going to find this on Power E-Trade on the options chain. So volatility typically reverts to the mean, as I mentioned. When implied volatility is high in the historical volatility range, a trader is expecting that volatility will contract in time. When implied volatility is low in the historical volatility range, the trader expects an expansion. So what is that range and where do I find it? Well, right there you can see where the current implied volatility is at for McDonald's relative to the 30-day average. So you can see is that volatility, the implied volatility, is quite high. It's quite extended or expanded from where we'd anticipated. And then you can see that as we go out in time, that there is a little bit of a tighter or a lower delta between the 30-day average and between the implied volatility. The way that we can get this a little bit more numerically driven is the implied volatility rank, and that's looking at the next option, and that's the 126% that we can see. So it is trading 126% higher than what we would expect. The current implied volatility is 26.08. And then the 52-week high implied volatility range has been as low as 16.25 and as high as 24.05. Now, of course, today it's showing 26.08, which is going to be 126% of its historical range. Now, that's the implied volatility range. Now, we've already looked at the chart on McDonald's to see that implied volatility generally exceeds historical volatility, but by how much? Well, look at the 52-week historical volatility range. It's been as low as 9% and as high as 22.31. So we can kind of get an idea of how much people are over anticipating the moves relative to the actual moves that are received. And that's what the implied volatility constellation chart helps us to recognize and to see if there's any trends. Now, sometimes you'll go ahead and see a spike in this. Let's say that a big event was happening. If you're just looking at this chart, let's say April 8th. I may see a big spike there, and that spike would indicate to me, hey, something is going on around April 8th. Maybe I need to look at the calendar. Maybe I need to look at the news. There's something going on that people are willing to pay more for puts and calls around the April 8th expiration that they weren't for the April 1st expiration or the March 25th. So this kind of allows you an x-ray into what's going on out there and maybe even cues you into some things that you want to take a look at on a calendar for those binary events. Okay, let's take what we've been talking about and what we have been observing up to this point with McDonald's, and let's create a trade. And the trade I'm going to create is called an iron butterfly. And an iron butterfly is going to benefit from when volatility overstates, and we expect that volatility is going to revert to the mean or it's going to contract. And the options that are going to benefit most are going to be when we sell an at-the-money call or we sell an at-the-money put, or in this case, we're going to sell both the at-the-money call and the at-the-money put. Now, to ensure that we don't put ourselves into an unlimited loss potential by simply selling a call option, I'm going to go ahead and make it an iron butterfly, which is a defined risk strategy. And I'll go through a few more of those details here. But here's the general setup. It's McDonald's, and I'm looking at the March 22 expiration. So when I took this screenshot, that had about 17 days to go. I'm looking at the 240, which is about as close as I can get to being at the money. And I'm going to sell the 240 put. You can see it's at 535. And I'm going to sell the 240 call. Now, if I just sold the call and the put, it would be a naked trade. It would be a naked straddle. And I don't want to set up a naked position where I have unlimited loss potential. So to define the risk, to take away that naked, the naked nature of the trade, I am going to take some of the 595 that I'm bringing in, and I'm going to buy the 260. That's basically my how do I get out of this trade if things go horribly wrong? And at the same time, I'm also going to buy the 220 put. Now, let's go take a look at the order ticket so we can start talking about the risk and reward and how this trade would play out if it worked perfectly for us or if it worked perfectly wrong. Okay, let's take a closer look at the Iron Butterfly order ticket. An Iron Butterfly is where we're selling the at-the-money call and the at-the-money put. So we're bringing the premium in from both of those. Now, in order to make it a defined risk trade, and if we didn't make it a defined risk trade, then it would really be a trade in which we're naked or we have unlimited loss potential and just don't really want to do that. So I'm selling the at-the-money call, I'm selling the at-the-money put, and then I'm going to be buying an out-the-money put. I'm going to be buying the 220 in this case. So I've got 20 points of risk, and anything below 220 would mean that I'm protected by the put that I have purchased. Hate giving up any of the credit, but then again, I want to make this a defined risk trade. So I'm using the 220 put as sort of the backstop. And then I'm also using some of the credit and I'm buying the 260 call option. Again, I'm defining my risk. I'm defining my risk to the upside at 260. Since I'm selling the 240 call, I've created $20 risk to the upside, $20 risk to the downside, but I'm defining it. Now I'm doing that and I am generating a credit in this case. I'm going to go for the midpoint and use a limit credit of $9.75, and that will produce for me $975. Now next we're going to get into the snapshot analysis, and you're going to see that the $975 that we're bringing in, it's very unlikely that we're going to be keeping that premium, but we're also defining the risk as well. So next, let's get into the snapshot analysis. So here we've landed on Power E-Trade snapshot analysis, where we can get a little better look at our McDonald's Iron Butterfly. Now, take a look real quick at the maximum profit. Remember I had said that we were going to generate a credit of $975, and that's exactly what's going to happen if we execute this trade. But notice that the probability for us achieving that maximum profit of $975 is just 0.06%. So with an Iron Butterfly, it is highly, highly unlikely that you're going to keep that entire credit. And the reason why is that the stock has to end at absolutely exactly that 240 point. And it's very unlikely that it is going to end right at 240. That's why we have such a low probability that we're going to achieve that. Now, the maximum loss is going to be 1,025, and it's giving us a just under 14% chance of reaching that maximum loss. Hopefully we don't. Now, I think the real tale, the real power of the Iron Butterfly comes in talking about the break-even point. Notice our break-even range is 230.25 and 249.75. This means that we have a very large range. The stock is currently trading at 240. Over the next couple of days while we have this option trade on, provided the stock stays higher than 230.25 and lower than 249.75, there is going to be some profit in the trade. Again, it's unlikely that it's going to end right at 240.00 and we're going to end with 975, but the closer that it stays to that 240, the more of that 975 that we're going to create. Now, again, this is just the overall P&L diagram. The next slide, we're going to go in a little bit deeper and we're going to look at TradeLab. And this way we can talk a little more about what will happen for a movement to the upside or downside. How is time decay going to either help or harm the trade? And what's going to happen if volatility expands even further, or if it does what we're anticipating, which is a contraction in volatility. So let's get on and take a look at the TradeLab and the analysis there. Okay, now we're taking a look at Power E-Trade's TradeLab and the risk metrics associated with the McDonald's Iron Butterfly trade. Let's look at what happens as far as price sensitivity goes. The position will like lower prices. That'll be a $10.29 change for a $1 change in the stock with that position. Now, that's initially what it would look like. Now, if the stock were to go down, let's say $1 or $2, and we were to redo the risk metrics, it would pop up and say that it likes higher prices. So really, when you're doing an iron butterfly, what you were anticipating and what you were hoping is that the stock is going to stay very near that current price. Now remember, we're going to profit from it staying within the range, but we will profit more if it stays very, very close to 240. But initially speaking, right out the gate, it likes a lower price. And that's probably just because the way we set the trade up, it's slightly skewed initially to the downside, but if it goes down this $1, it will then change and say, oh, it likes higher prices as well. Now, how about sensitivity change? This is going to be the gamma. In this case, price sensitivity grows with lower prices. 329 just means that $10.29 will start to change by $3.29. But the real kind of where the rubber meets the road with these trades are going to be the next two, and it's time decay. So remember I talked about how one thing we could be confident in is that time is going to move forward. Well, with the McDonald's iron butterfly, time decay is going to work in our favor, and it likes time passing. Every day that the trade continues, the hypothetical gain from time decay is going to be, or theta, is going to be $16.17. But the real mover of this trade is not price or time. The real mover of the trade is going to be the volatility sensitivity, or that vega contraction that we talked about. And it likes lower implied volatility, $22.47 for a 1% change. So again, if we're looking at McDonald's contraction of volatility from its current levels, where it's at 126%, so it's extremely high in its 52-week range, if we think that volatility is going to contract, if it's just going to settle down a little bit, and price is going to stay more in a defined range, that's going to benefit the trade quite greatly. So if we were to categorize, what it is that we're looking at or what we're looking for in the trade, it's sensitive to everything. But what's it most sensitive to? I just pulled up the interest rate sensitivity. Not really very sensitive to interest rates. And then again, it's not likely that we're going to see a full 1% change in interest rates, even though it is likely that we may see, let's say, a 0.25 change in interest rates. But what is it most sensitive to? Well, the key driver of this trade being profitable is going to be volatility. That would be the number one. We want to see that contraction. The second one is time moving forward. So again, moving forward in time, we're going to benefit from the time decay. And the third one is going to be price sensitivity, although recognize that the way the trade's been structured, that if it goes down a buck or two, well, it's going to then say it wants to go up a buck or two. The way an iron butterfly should work is that it stays very near the current price or stays contained within that range. Okay, now that we've set up the iron butterfly, we've done the snapshot analysis, we've done the risk assessment as well. If we're ready to execute the trade, here's how it looks. We're selling one iron butterfly with a limit that's going to be a credit to the account. And you can see we are selling the 240 put and the 240 call. And we are buying the 220 put and we are also buying the 260 call. That will define our risk. We're doing that for a total of $972.96. That would be the commissions that are excluded out of the credit amount. And if we're ready to send that order, then we send that order in and we set the trade up as an iron butterfly. We hope that time moves forward. We hope that the stock stays contained within that range and stays very near the 240 strike price where we've sold the call and that we've sold the put. We hope that volatility contracts, and by staying near that range, volatility should contract without the stock making moves higher or making moves to the lower. We expect vol to contract. We expect those two short positions, the vega, to benefit us as things contract and hopefully revert back to the mean. If we're okay with all that, we send the trade in and hope for the best. Well, now that we've set up the McDonald's iron butterfly, let's spend a little bit of time and talk about the management of the position. It's really quite straightforward. If McDonald's begins to show signs of a directional bias, remember we did the trade anticipating that it was not going to be going up or not going down, that it was going to stay within a range. So if it begins to show that it's going to the upside, you're going to want to close out the call side of the iron butterfly. If it's showing that it's going to, if you anticipate that it's going to go down more than you anticipated, then you're going to need to close out the put side. So you don't need to close the whole iron butterfly. You just need to close out the threatened wing of the butterfly because of that directional bias. If McDonald's volatility is showing signs of expanding, remember this trade benefits from a contraction of volatility. So if it's showing signs of expanding beyond that 28% volatility, that may be an indication to just close the trade outright. Remember, volatility is going to be the top driver of the profitability or the lack thereof with this trade. So if you're seeing that expansion, just consider closing out both sides. Just undo the trade, whatever you did to put the trade on, reverse those actions, and that will close the trade out. So time is on your side. Remember, every day we were seeing that we were going to be benefiting from time decay. So time is on your side with this iron butterfly. And that lack of movement is what you want to see. That's sometimes not what people are used to when they're used to buying calls and buying puts instead of selling calls and puts, like with the iron butterfly. So you want to see time move forward. You want to see lack of movement. It's that lack of movement or this back and forth vacillation or oscillation within the narrow range that you're hoping to see. You know, a little bit higher than 240, a little bit lower than 240, but hopefully staying right around that 240 range. That will bring down volatility, that will contract volatility, and that contraction, again, will benefit the position. It is highly unlikely, with just a 0.06% chance, that this trade is going to experience the maximum profit. The only way it's going to experience maximum profit is if at expiration it is 240.00, a very unlikely situation. So therefore, you need to anticipate and prepare and then close out the position prior to expiration. When you close out the position, that is when you will either realize a gain or a loss in the position. Because the short call and the short put are both subject to auto assignment, and I doubt that you want to have anything to do with McDonald's shares, either buying or selling it. So when you put on an iron butterfly, expect that you are going to be closing it out. Now, the situation in which you would not need to close the trade out is kind of the most unfortunate situation. And that is if McDonald's reaches expiration and it is greater than 260, that would mean that it is higher than the long call, or lower than 220, which means it is lower than the long put, then you will be at a maximum loss position. It cannot be both higher than 260 and lower than 220 at the same time. But if it is higher than 260 or lower than 220, then you're going to be at maximum loss. So one side of the iron butterfly will auto assign, and simultaneously it will auto exercise. And I guess the only good news here is you don't need to take any action in this situation, but you are going to be suffering maximum loss. So hopefully you understand the management of it. Hopefully you do not experience that last bullet point right there. But again, if you do, it's good that you prepared for maximum loss in this case. So that's the outline of the McDonald's iron butterfly. It is a trade that is anticipating a contraction of volatility, either ahead of earnings or around earnings, or really just any time that we expect that a stock is going to trade in a narrow range where the market is overstated volatility, and we expect that volatility is going to contract, stay in that range, and time is going to move forward. I hope this video on earnings and options has been both interesting and helpful to you. This video is just one of dozens of educational videos we offer at eTrade. For a full list of all our educational materials for both investors and traders, please point your browser to etrade.com/education. For the entire content and education team at eTrade, thanks for joining us today, and all the best to you in your stock market endeavors.